So there was an owner of a practice we talked about who had crossed $1 million in revenue for the first time. Best year the practice had ever had, more clinicians, better collections, a real profit margin. It was also the first time that she had owed money at tax time, a lot of money. She wasn't a client of ours at the time, and her books were a bit behind, so her previous bookkeeper eventually got the books current. But by then it was March, and there was nothing left to plan around. She ended up doing her own return, scrambling, and writing a check that she had not budgeted for out of an account that was supposed to cover payroll. Here's the part in all of that that's worth sitting with. Nothing went wrong. The practice performed, everything went well, everything grew, including that tax bill. That tax bill was the receipt for a great year. It only felt like an ambush because nobody had set aside the money as it came in. Saving for taxes in a private practice is not necessarily complicated math. It's really a system that you run every month so that when April rolls around, it's a formality instead of a big event. So, we're going to walk through how to set up a system like the one that we set up with our clients to help you avoid any sort of tax ambush like in that story. So, more profit means more tax. That's kind of the whole mechanism with taxes. And it catches people because the two numbers, profit and tax, move on different schedules. Your profit shows up in real time, right? You feel it in the bank account in June, but the tax on that profit doesn't actually arrive until the following April when taxes are due. And by then, you've already spent some version of that money on a new office, a new hire, distributions, all just the normal expenses in a business. And two things can make it even worse in a growth year. So, your prior year, the year before, is a bad guide for how much tax to set aside. If you set aside tax based on what you owed last year, and then this year's profits are up 40%, you're underfunded by roughly that same 40%. So the system that works fine at 600,000 in revenue breaks at $1 million in revenue. And unfortunately, this is oftentimes the advice that's given to practice owners. Just go off of what you did last year. The problem is that if you have big growth, that's not going to work. Second to that, another problem is books that close late really remove all of your options. Tax planning has to happen before the year finishes, right? It can't be happening December 31st. An S corp election, a retirement plan contribution, an equipment purchase, an office build out, an officer salary adjustment, all of these need current numbers and time. Your books that get caught up in February tell you what happened for the last year, but they can't change it. You can't now do much at all for that previous year. The gap between bookkeeping and tax strategy is where a lot of those surprises live. So you have to have books that close on time. You can't be doing a cleanup the year after or 6 months later, things like that. So let's talk through the four pieces of the system to really get around this and put in this system so that you're ready to go when it comes to taxes. None of this is hard on its own. It's just running all four of these together to make that tax bill a non-event. So the first piece is you need to have a dedicated tax account. This is a separate bank account, not just like a spreadsheet or something that you're set aside in your head, but an actual separate tax account. If you are running profit first in your practice, you should have a tax account already and you're, already there on this side of it. Second, you need to have a target percentage. This is a number that's going to get set with your bookkeeper, maybe confirmed with your CPA. It's not just like a number that you heard somewhere else. It's an actual percentage that's lined up with some math and some calculations below it so you know how much money to set aside into that dedicated tax account. This has to be specific to your situation, your tax bracket, your entity type, your state. They all change this number. So it has to be a number specific to you. Number three, quarterly estimated payments. You really need to be making payments to the IRS and to your state 4 times a year instead of just one huge payment in April. This is what the IRS asks you to do. If you don't do this, there are going to be penalties, but it also makes it so that cash flow wise, you're paying 4 times a year instead of once. It's a lot easier and a lot more less traumatic, I guess. It's just less traumatic to pay those payments in 4 pieces rather than one big payment. And fourth, you have to have your books closed monthly. If you're only doing your bookkeeping once a year, if you're doing it once the year is done, there's no planning that can happen. There's no optimizing that can happen. So you need to get your books closed monthly so that your CPA can plan in September or October instead of reacting in March when they're putting that tax return together. Ideally, your books are closed around the 15th of the next month. So like if we're in August right now, we would hope that your July books are closed by August 15th. That's how quickly your books should get closed, and that gives you the time to plan and make changes. So let's talk a little bit of the calculation, which was point two, coming up with that rate that you're going to set aside into that separate tax account. So this is a step that makes this whole system self-correcting, and very few people do this. So first of all, your tax percentage, so the percentage you're going to put into there, is going to be a percentage of profit. But the problem is that money doesn't just come into your account as profit, it comes in as revenue. So if you allocate a flat dollar amount every month, right? If you just say, I'm going to set aside $2,000 a month, that doesn't really work when the practice grows, because $2,000 on a smaller amount of revenue doesn't work on a larger amount of revenue, right? So we're going to do a percentage of every deposit, and it's going to just scale on its own. Where more money comes in, we're setting aside more into the tax account. So let me give you some real numbers to kind of hopefully make this concrete. So let's say that your practice collects $1 million in revenue, and has about $180,000 in profit. This is in a year. That's 18% profit margin, right? 180,000 on 1 million, which is very positive, very good for a group practice. Let's say that your CPA tells you they want to set aside about 30% of profit to go towards federal tax, maybe self-employment taxes, state taxes combined. That's pretty normal. Somewhere between 20 and 35% of profit is what you want to set aside, depending on, again, your entity type, your state, your situation, your tax situation. So we want 30% of our profit set aside. So if our profit's 180,000, we want 30% of that. That's 54,000. 30% of 180,000, 54,000. That's how much we want to set aside for taxes. That's what we think our tax bill will be. If we divide that, so we take 54,000, we divide that by $1 million, which is our revenue, that's 5.4%, right? 54,000 is 5.4% of our revenue. So basically, we need to set aside about 5.5% of our revenue to hit that goal. So that means that every dollar that comes into our account as revenue, we should set aside 5.5% of that into our tax account. This should happen either weekly or every 2 weeks. Some people do this based on kind of the payroll schedule, but I wouldn't break this out further than every 2 weeks. You want to move that money so it's set aside into that tax account. So here's how this kind of works, okay? So if you have $80,000 in revenue in a month, 5.5% of that would be $4,400. So you move that $4,400 into your tax account. If you have $110,000, so it's like a really strong month, lots of money coming in, maybe it's historical collections coming in, then you'd set aside a little over $6,000, $6,050. So you can see that money that you're setting aside grows as the money coming in grows, right? So the tax liability grows, more revenue, more profit, and you're going to also set aside more money as that happens as well. If you had just kept that money at a flat $4,500 per month, just a flat dollar amount, it's not going to work, right? Because as more revenue comes in and you have more profit, your tax amount that you're setting aside doesn't change. So you need to have that amount changing as the profit changes in the business. And, you might say, well, more revenue coming in doesn't mean more profit. And that's very true. So what you're going to do is you're going to recheck that percentage every quarter against your actual profit. So like if you check and your profit margin is no longer 18%, like now it's 22%, then we're going to increase that percentage. If it goes down and, hey, last quarter our profit was actually 12%, then we can take a look at that and adjust that, right? It's not the worst thing to oversave. So we do that verification every quarter, check to make sure your profit margin is where we planned off of. And if we need to take some money out of that tax account because we oversaved, great. If we need to add a little bit more, then we can do that too, okay? But we're going to set aside that percentage every few weeks or every week, put it in that tax account, have it separated, set aside. You're going to pay your estimated taxes out of that. And then when your tax bill comes at the end of the year in March or April, then you're going to pay that end of the year tax bill out of that as well. And then we'll do that quarterly check-in to kind of see where we are throughout the year. So a couple things to talk about, right? This is a plan. It's not a guarantee, right? So we're going to need to adjust things as we go, like I just talked about. But also another thing to think about is like entity type, for example. Your entity type changes the math quite a bit. If your tax is an S corp, part of your income is already running through payroll with taxes withheld. So that tax percentage that you need to set aside may change. So that's a good thing to talk to the CPA about. Hey, since I'm paying myself this much through payroll, how does that change how much money I need to set aside from the business's profit? A lot of people talk about safe harbor, right? Safe harbor is the rule that the IRS says that if you pay at least 90% of this year's tax or 100% of last year's tax, whichever is smaller, you're not going to pay penalties, which is great. We don't want to pay penalties. But Safe harbor still means that you might have a huge tax bill, right? Because if you grew a bunch, safe harbor is going to cover you so that you're not paying penalties, but you're still going to have to make up that difference in the practice growth. So safe harbor is good. It protects you from penalties, but it doesn't protect you from the actual bill that you're going to pay. So just be aware of that. Safe harbor is not like a catch-all. It just is avoiding penalties from the IRS. Distributions are tricky. How we think about those. Remember that distributions are not free. Taking money out of the practice does not reduce or change what you're going to owe on taxes. If your draws are outrunning your profit, this is a good thing to look at. This happens with many practices, and that can really hurt cash flow as well as how much you're setting aside for taxes, right? So if your profit is 20,000 for the year and you took out 25,000, you probably don't have any money to set aside for taxes. So your distributions need to run below profit. That's an important thing to think through. And then finally, don't raid the tax account. The tax account only funds one thing: taxes. If payroll is regularly pulling from it, if operating expenses is pulling from it, the problem is probably cash flow, which maybe has to do with distributions as well. But that's a whole separate fix. Do not pull from that tax account unless it's for taxes, or if you're oversaved, then you can pull from that a little bit. And then, a couple things to think about if you are behind right now, right? Like if you're reading this in August, your books only go back to April, everything else is not done. Really, the first thing you need to do is just get your books current. That's the first thing. You can't set a percentage and do this whole process until we really know where the numbers are. So get your books current, get them caught up, have someone do a cleanup so that you are caught up current. And then from that point, then you can start to look back at, figuring out where's your profit to date, how many more months do we have the rest of the year. You can kind of try to figure out where you are and what the rest of the year is going to look like. Do a little bit of projection, right? We're at 50,000 in profit so far. If we divide that per month and then project it forward, how much profit is that the rest of this year? And really, the best thing you can do after getting your books current is just open the account, open that tax account, start allocating some money into that tax account. Doing it partially definitely beats not doing it at all. So even if you're not putting aside as much as you need to, like maybe you figured out you need to set aside 5.5%, but you can only do 2%. Still do 2%, right? Just get that going, get it started, and slowly you can increase that percentage to make that full allocation that you'd like to make. Okay. The last thing to leave you with, right? This is really the one question that matters. If a tax bill arrived today, do you have the money already in your account, right? If you owed a tax bill, look at your profit, for example. Okay, look at your profit for the year. Take 20 or 30% of that. If you got a tax bill for that today, could you pay it? If yes, you're good. You can stop thinking about this. If no, if you don't have that money right now, what we just talked about is exactly what you need to start working on and building. We have a historical sheet that we put all of our clients' numbers in from QuickBooks, and it has just a little calculator on the side that calculates 25 to 35% of profit. You could do that with your numbers as well, right? Look at your profit, calculate 25 to 35% of that. Do I have that right now set aside in my tax account or paid into estimates? And that gives you that really easy litmus test. Would I be okay if the year ended right now? And what is April going to look like for me this year? Is it going to be another struggle to scramble and fund that tax account? Or am I going to have that money in that tax account and it's actually not going to feel like a stressful situation at all? It's one of the best moves you can make. It's going to really relieve a lot of the stress that you have. So go through this process, think through it. And if you have questions or if you want help talking through this, schedule a discovery call on our website. Happy to talk through this with you then.